So today we're going to look over journal entries and normal balances. So the first thing that we're going to look at is this chart, this T account showing the normal balances of different accounts. So let's just focus on the debit side right now. So the left side is accounts that have a normal debit balance. So the first one is going to be assets. So things like cash, accounts receivable, supplies, inventory, all of those have a normal debit balance. Drawings, so owner's drawings, also has a normal debit balance. And then all of your expense accounts have a normal debit balance. So assets, drawings, and expenses, ADE, all go up with a debit. Now over on the other side, accounts with a normal credit balance are going to be your liability accounts. So that's any account that has the word payable in it, that's your unearned service revenue. All of those have a normal credit balance. Then your owner's capital. Your owner's capital account also has a normal credit balance. And lastly, your revenues have a normal credit balance. So, memorizing which accounts have a normal debit balance and which accounts have a normal credit balance is going to be crucial for your success in accounting. And the reason behind that is because what these normal balances mean is how you increase and decrease an account in a journal entry. So those accounts with a normal debit balance increase when you debit that account in a journal entry. So to increase an asset, you would debit that account. To increase your expenses, you would debit the expense account. That also means that if we wanted to decrease any of those accounts, we would have to credit that account. So if you use cash to pay for something, you're going to want to decrease your balance in cash, which means that we would have to credit our cash account. Same sort of idea over on the other side with liabilities, capital, and revenues. To increase those accounts, we would have to credit them, and to decrease, we would have to debit them. So knowing this chart and knowing your normal balances will allow you to take a look at a transaction and be able to talk yourself through it as to what you need to do to prepare a journal entry. If you know that you need to increase an asset, well, then you know that that's going to be one of your debit accounts in that journal entry. If you know that you need to increase a liability, then you know that that's going to be one of your credit accounts in that journal entry. So I can't stress enough how important this information is. So we have that chart still up in the upper left corner, and we're going to just walk through a series of transactions and talk about the process of preparing these journal entries. So our first transaction here for February 1st says that the owner invests $25,000 in the business. So the very first thing that we need to do is think about, okay, which accounts are being affected here? So an owner is putting money in the business. So that means that the business is getting cash, right? The business is getting $25,000. So cash is going to be involved. The other account that's going to be involved here is owner's capital. Because whenever an owner invests money in the business, they're going to want a piece of that business, right? So we put that under owner's capital. So those are our two accounts that are affected here. So when we work down into the journal entry portion, we need to think about, okay, which account's going to be debited and which account is going to be credited. Well, cash is an asset, and the amount of cash that the company now has gone up, right? The company now has an additional $25,000 in cash. So we need to debit our cash for $25,000. So we would write cash in our first line of our journal entry, and under the debit column in our journal page, we would put the $25,000. Now, every single journal entry has to have at least one debit and one credit, which means that we would then know, okay, well, we're debiting cash, so that means that we must credit owner's capital. But let's think about why. So owner's capital is what the owner has in the business, right? So if they invested money in the business, that means that their capital has to increase. And we can see on that chart in the upper left, the capital increases with a credit. So we will credit owner's capital. And you'll notice the credited account is indented in a journal entry. So we will first list out all of our debited accounts, and then list all of our credits, and those accounts that are being credited have to be indented. So then that way, when we're looking down a journal page, we can easily see which accounts are debits and which are credits. So that's going to be our journal entry for this transaction here on February 1st. Now we're told on February 1st, we also hire a part-time employee, and they will be paid $900 per month. So this is something that you will probably encounter at some point working through this chapter, is you're going to be told that the business has hired an employee. Well, just hiring an employee is not a transaction. All you've done here is called up someone that you interviewed and said, hey, congratulations, you got the job. They haven't worked for you yet. They haven't gotten paid yet, right? So there's nothing to actually record here. And so since it's not a transaction, no accounts are affected, and you would not need to prepare a journal entry. So journal entries are only prepared for business transactions. Now on February 3rd, it says you purchased $500 of supplies from OfficeMax on account. So this is a business transaction, so we are going to need to journalize this one. So we need to think about, okay, which accounts are being affected here? So we purchased supplies, right? So that means that we need to affect and change our supplies account in our books. And how did we pay for these supplies? Well, it tells us that we purchased them on account. And if you purchase supplies on account, that means that you will owe money in the future, so we're dealing with accounts payable. Now, before we work into our journal entry, we can think, how are these accounts being affected? So supplies, which is an asset account, is increasing because we are buying more supplies. So we have additional supplies, so we want to increase our supplies. And we see in that chart in the upper left that to increase an asset, we need to debit that account. So we will debit our supplies account for the $500 of supplies that we purchased. Now, the other account here, accounts payable, is a liability, and we owe OfficeMax more money now, right? If you buy something on account, that means that you owe the seller more money. So to increase our accounts payable, we see that we would have to credit that account since it's a liability. So in our journal entry, we will indent accounts payable because it is being credited. So we will credit our accounts payable here for $500. Now, another important piece to remember, your debits must equal your credits, right? So if we just take a look at this entry itself, supplies is debited for $500, meaning we got $500 worth of supplies from OfficeMax. Accounts payable is credited $500, meaning that we owe OfficeMax $500. We need those two amounts to equal. We cannot debit supplies for $200 and credit accounts payable for $500 and call it a day. Now, when we're working with journal entries that have 3 or more entries or 3 or more accounts in a single entry, then it's the sum of the debits must equal the sum of the credits. But just remember that your debits and credits need to equal in every single journal entry. Now on February 7th, you perform services on account worth $1,500. So which accounts here are being affected? The first one is service revenue. Whenever we see that we perform services, that means that we've done the work, and so we need to count the revenue. So here we will affect our service revenue in this journal entry. Then we can think about, what are we getting for all of these services that we're performing? Are we getting cash? Are we getting paid in equipment or supplies? Well, it tells us that we performed them on account. So that means that our customers will pay us later. And whenever a customer is going to pay us later, we are dealing with accounts receivable. So those are the two accounts that will be affected here. Now we can think about our journal entry. Service revenue has to increase because we are performing more services. So we need to increase our revenues. And we see that revenues increase with a credit. So that will be listed after our debited account in this entry. Remember, your debits always go first in your journal entries. So accounts receivable is an asset, and we want to increase that asset because our customers owe us more money. So we will debit accounts receivable for $1,500 because our customers owe us $1,500 more than they did before this transaction. Then, to increase our revenue, we will credit service revenue for $1,500. Now, February 9th, we pay back $500 to OfficeMax for supplies purchased on account on February 3rd. So a few transactions ago, we bought those supplies on account. Here, we're paying back OfficeMax. So what accounts are being affected? Well, the first one's going to be cash, right? We are going to pay back OfficeMax $500 in cash. So our company's cash is being affected. The next one is accounts payable, because the amount of money that we owe OfficeMax is now changing since we're paying them back. So now when working on this journal entry, we need to think about what is happening to these accounts. Well, your cash account has to decrease because we are paying money to OfficeMax. So we are paying money to OfficeMax, so we need to show that our cash is decreasing. Now, cash is an asset, and we see in that chart that assets increase with a debit. But to decrease an asset, we do the opposite. So we're going to end up crediting our cash in this entry. Accounts payable is a liability, and we see that liabilities increase with a credit. But here, we're going to want to decrease our accounts payable because we owe OfficeMax less money because we are paying them back. So to decrease your accounts payable, you're going to debit that account for $500. Because we need to show that we owe less money now than we did previously. So we'll debit our accounts payable and we will credit our cash. So it's important to remember that any account can be debited and any account can be credited. It all just depends on what you're trying to do in that journal entry. Now, on February 10th, you receive payment from customers in full from February 7th services. So it got cut off here on the slide, but that's just showing over below the transaction from February 7th when we performed services on account. So here we need to think about what accounts are being affected on February 10th. Well, our cash is being affected, right? Because we are receiving this payment. So our customers are giving us this money. The other account that will be affected here is accounts receivable, because we will want to show on our books that these customers don't owe us this money anymore, right? Since we're receiving payment from them, we need to say, okay, customer A, B, and C don't owe us anymore for these services. So our cash is going to have to increase and our accounts receivable is going to have to decrease. So to increase cash, which is an asset, we will debit cash. And to decrease accounts receivable, which is an asset, we will credit accounts receivable. And we get that $1,500 by taking a look back on February 7th to see what was the full amount of those services that we performed. Now, February 16th, a customer pays $250 for services. So this is a new customer, new services that we provide, and they're paying us this money. So we think about, okay, which accounts are affected here? First one is cash. Customer is paying us $250, so the amount of cash that we have has just increased. And why did they pay us this cash? Because we performed services for them, right? So whenever you perform services, we need to count that revenue. We need to count our service revenue when we do the work. So your cash is going to be increasing here because a customer is giving you money, and your service revenue is also going to be increasing because we have performed services. So to increase cash, we debit our cash account because we need to increase the asset. And then to increase service revenue, we credit our service revenue account because revenues go up with credits. So that's our journal entry there for February 16th. Now, February 22nd, receive utility bill of $250. Payment is due on February 28th. So, we need to think about how is this going to affect our accounts? Well, the first thing that will be affected is your utility expense. Since you have used these utilities, you need to count the expense when it happens and not necessarily when you pay it. Right? So what's important is that we record the expense here on February 22nd. So we need to affect our utility expense account. Now, we aren't going to be paying this today, right? It says that we're going to pay it later on in the month. So we aren't going to mess with cash at all, but we are going to mess with accounts payable, right? Because we owe this money in the future. So we can think about what we need to do with these accounts in this journal entry. Utility expense has to increase because we have more expenses now. So to increase an expense account, we see that we debit that account. So we will debit our utility expense $250 for the amount of the utility bill. Accounts payable, well, we now owe this utility company $250. Right? So we need to increase our accounts payable by $250. So we will credit accounts payable $250. Couple more here. So on February 26th, the owner withdraws $100 for personal use. So which accounts are being affected? The first one, owner's drawings. Whenever we see that an owner is taking money out of the business for personal use, vacation, just to pay themselves, that's going to be called owner's drawings. Now, what is the owner taking out of the business? Cash, right? So the company's cash is being affected in this transaction. So now we work down into the journal entry. And we need to think about, okay, which account are we going to be debiting? Well, our owner's drawings are increasing, right? There's now more owner's drawings than there were on February 25th. So we see to increase our drawings account, we need to debit drawings. So that will be our debit in this journal entry. Now, cash, this is when we need to make sure that we are looking at these transactions from the point of view of the company. The company is losing cash here on the 26th, right? The company has just lost $100 of cash. Yes, the owner put $100 of cash in their pocket, but we are the company and not the owner, right? So the company's cash is decreasing. And to decrease an asset, you will credit that asset account. So we credit cash for 100. Now, on February 28th, we are paying the employee for the month of February. So we were told back at the very start of the month that we hired a part-time employee and that they'll be paid $900. So here we need to record now that they've actually done the work and we have to pay them. Right, back on February 1st when we just hired them, that wasn't a transaction. So we didn't have to record that one. But now they've done the work and we are paying them here at the end of the month. So what accounts are being affected? Well, the first one's going to be cash, right? Because how are we going to pay our employees? That's going to be cash. And this is probably a good time to let you guys know that checks are also going to be treated like cash, right? Typically, when you pay your employee, you're going to write them a paycheck. But when we are dealing with accounting, whenever we write a check, we treat that the same as just cash. Now, the other account that will be affected here is our salary expense account. Now, you might see this as salaries and wages expense, and you might just also see it as salaries expense. It's the same thing, just two different names for the same account. So now we can look at our journal entry here and think about what we need to debit and what we need to credit in this entry. So our expenses are increasing, right? We have more of a salaries expense than we did previously. And to increase an expense account, we need to debit that expense account. Now our cash, we are paying our employee, so our cash is decreasing. And to decrease cash, which is an asset, we need to credit cash. So that's going to be our journal entry there when we pay our employee for the month. Now, we also need to pay that utility bill that we received back on February 22nd. So we need to think about, okay, which accounts are being affected? Well, the first one's going to be cash, right? Because we are paying this bill now, so our cash will have to decrease. And the other one is going to be accounts payable. Notice that utilities expense is not listed here. We already counted the expense back on February 22nd when we received the bill. So we don't want to count that expense again. So here, we're just paying money that we owed. So your cash is decreasing, and to decrease an asset, we have to credit that account. Accounts payable is also going to be decreasing here, because we will owe less money after we make this payment. And to decrease accounts payable, which is a liability, we have to debit our accounts payable. So we'll debit accounts payable $250 to show that that account's balance is decreasing. Then we'll credit cash for $250 to show that that account's balance is also decreasing.